Welcome back. Now in this lesson, we shall talk something about the source of capital. The company in which you are going to invest your money, you should know as to what is the source of capital or where the money is coming from in that company. Alright. So in the previous lessons, we have seen that the capital structure of this company called as Five Friends Garments Limited. The capital structure was $2 million of debt and $18 million of equity. We had seen that the debt equity ratio was 1:9. So primarily there are two sources of capital. One is the debt and the other is equity. Debt is basically the borrowing or the loan which the company takes. This loan or the borrowing can be from a bank, it can be from any financial institutions, it can be from any non-banking financial institutions or non-banking financial companies, or it could be in the form of corporate FDs, fixed deposits. The company may ask the public to deposit their money in the form of corporate fixed deposits in the company, or it could be in the form of debentures. The company may issue certain debentures to the public, or it could be also in the form of bonds and other things. These are the various forms. There could be other things also in which form the company can borrow money. And the second part is the equity, which is the money of the stakeholders or the shareholders. Now, equity can be in the form of ordinary shares or it could be in the form of preferential shares. You see, when we talk about the stock market, we are primarily concerned with ordinary shares. You as an investor or a trader in the stock market, you will be concerned with ordinary shares. Preferential shares are something little different from ordinary shares. What are preferential shares? This I have discussed in detail in one of my other courses, that is about the fundamentals and concepts of finance. But here it is not very much relevant. You may just want to, Google and see what are preferential shares, but more than that, not required to know here. What we shall be dealing with or what we are concerned with in the stock market is basically the ordinary shares. Alright. So now the question is, which one is preferred, the debt or the equity? And should the debt be more in a company or the equity should be more in the company? Now these are not straightforward answers. You cannot answer such questions in yes or no or this or that. They are quite complex issues and the answers to these questions will depend upon various things. For that, you would need to understand the significance of debt equity ratio in a company. Now, this debt equity ratio again, I have explained in detail in one of my other courses, that is about understanding the financial statements. But notwithstanding that, as we proceed, I will again touch upon this issue very briefly. But the question which you may ask me is that as an investor in the stock market, why is there a need to know all this? Why should you know the debt and the equity and the debt equity ratio? Again, my answer will be that for a comprehensive understanding, you need to know all this. After all, when you are investing your money in a company, you are becoming a very, very small stakeholder or the owner of that company. And before you put in your money in that company or you buy a small portion of that company, would you not want to know as to where the money is coming from into the company? How much is the borrowed money? How much is the own money of the company? All these things have a significance and a relationship with the value of the share. And therefore, you need to understand all this. For the time being, let us try and understand the difference between debt and equity. Alright? Once you understand the conceptual difference between this debt and equity, you will be able to appreciate their importance. Now, to understand this, first of all, debt, as I have told you, is a loan. Once a company takes a debt, it has to be returned back someday. Until the time you completely return the debt, you have to keep paying an interest for that debt. But when we talk of equity, equity is actually a stake and ownership in the company. That has not to be returned to the person who has given that equity. If you have bought a share in a company, the company is not liable to return your money to you. You may sell your share to some other person, but the company is not bound to repay you for that share. Alright? And then the lender of the debt is not participating in the business of the company. The lender, the person who has given money as loan to the company, has given it on a fixed return in the form of interest, irrespective of whether the company makes a profit or makes a loss. Even if the company is sustaining a loss, the company has to pay the interest on the loan which it has taken. But that is not so with equity. The shareholders or the equity holders are actually a participant in the business of the company. They may not be participating in the management of the company, alright, but definitely they are participating in the ownership of the company. A very, very small, minuscule ownership of the company they do have, the owners of the shares, alright. So if the company earns a profit, then the shareholders will deserve something in the form of dividend or in some other form. But if the company is not generating any profit, then the company is not liable to pay anything back to the shareholders. Again, the lenders may take a collateral guarantee from the company. When somebody is giving a loan to the company, that person or the institution which is giving the loan can ask the company to give some collateral guarantee in the form of land of the building, or maybe the machinery of the building, or maybe the building of the company itself. Some or other form of collateral guarantee the company who is taking loan has to provide to the institution which is giving the loan or the person who is giving the loan. But there is no such guarantee for the shareholders. If you are buying a share in the company does not give you any collateral guarantee. Alright? Then the most important thing is that if the company fails or goes bankrupt, then the assets of the company, whatever are remaining, the plant, machinery, equipment, land, everything will be auctioned and the government's dues will be cleared first. After clearing the government's dues, the money which belongs to the lenders, that will be repaid first. The people who have given loan to the company, the fixed deposits, the bonds, the corporate FDs, all these things will be repaid first before returning the money to the shareholders. Then after clearing all the dues of the government and the dues of the lenders, then if anything remains, that will be distributed among the shareholders. And that obviously will be less than what the shareholders have contributed, because we are considering a scenario where the company has gone bankrupt or the company has failed. So therefore, its assets will not fetch that much of value which was initially invested. So therefore, after paying the dues of the government and paying the dues of all the lenders, very little amount will be left if at all, and that amount will be proportionately distributed among the shareholders. Another thing to remember is that it is the responsibility of the lenders or the people who are giving loan to the company to take some collateral guarantee. If they have not taken any collateral guarantee and given the money to the company, and tomorrow if the company fails, then the lenders will lose their money. The shareholders are not responsible to repay the loan which the company had taken. If you recollect our initial lessons where we had talked about as to who has taken the loan, is it the promoters of the company or is it the company which has taken the loan? The loan was taken, the debt was taken by the company. Therefore, the company is liable to repay that loan, not the shareholders. If the company goes bankrupt or sustains a huge loss, then the lenders can recover that money by disposing of the collateral guarantee which the company has given. But they cannot come to the shareholders and ask for that money. The maximum loss of the shareholders is limited to the amount of investment which they have made, nothing more than that. Tomorrow, the shareholders are not answerable to these lenders. It is the company who is answerable to the lenders. So it was the responsibility of the lenders to take some collateral guarantee before giving a debt to the company. So I hope this point of debt and equity is amply clear to you. As we proceed through the course, you will understand the significance of these things, and before investing in a company, you will minutely see as to how much is the debt, how much is the equity, and how is that debt equity ratio playing out. All right.